Okay, let's go ahead and I want to illustrate with an example from an upstream sale of land um, how things differ under the full versus the partial equity method. Let's go ahead and start with a real bare bones example. Let's go ahead and assume that on January 1st, 2001, Big acquires 80% of Little's voting stock for $80,000. The fair value of the non-controlling interest on that date is $20,000. Let's assume that Little's book value is $100,000, so there's no differential, and all assets and liabilities have book value equal to fair value. Little's owner's equity is comprised of $50,000 of common stock and $50,000 of retained earnings. And let's assume that Little isn't going to pay any dividends throughout this entire example. That'll just take one of the entries out of the equation. Let's go ahead and start by recording the purchase. So we buy our investment in Little for $80,000 and we write a check. Now if we were to prepare our elimination entry at the date of acquisition, it would be, again, we would eliminate the subsidiary's beginning of period equity accounts, and 80% of that would be our investment in Little. The other 20% would be the non-controlling interest. Now, please note the relationships. Little has equity of $100,000. Our 80% ownership is matched by our investment account, while the 20% owned by the non-controlling shareholders is reflected in their $20,000 non-controlling interest. Now let's assume that during 2001, Little sells land costing $10,000 to Big for $11,000. There's going to be a $1,000 gain on the sale of land. Let's also assume that Little reports earnings of $20,000 this year, which includes the $1,000 gain on sale. Let's go ahead and start with the full equity method. And again, under the full equity method, the parent in their equity method entries will adjust their investment income to remove any unrealized gains and losses. So our equity method entries, first, they're going to record their share of Little's reported earnings. Little reported earnings of $20,000. 80% of that is $16,000. But then under the full equity method, they're going to have to go ahead and back out or eliminate the unrealized portion of that. Again, of the $20,000 of earnings, $1,000 of that was the unrealized gain on sale of land. Again, unrealized because it hadn't been, the earnings process hadn't been completed, the land hadn't been sold to an external economic agent. So they need to go ahead and take away the portion of their investment income that was unrealized. So $1,000 of income was unrealized, their share of that, $800. So just to sort of summarize where we stand at the moment, our accounts, we have our investment in Little, $95,200, our initial purchase price, plus our share of the reported earnings, minus our share of the unrealized gain, and our investment income is $15,200. And again, that's essentially 80% of the $19,000 of realized subsidiary earnings. Now let's go ahead and prepare our elimination entries. First we have our S entry, where as always we eliminate the subsidiary's beginning of period owner's equity accounts, common stock and retained earnings. 80% of that, or $80,000, is our beginning of year investment in Little balance. The other 20% of that, or $20,000, is the essentially beginning of period non-controlling interest. That's the non-controlling shareholders' ownership interest in the beginning of period value of the subsidiary. A for amortization is not applicable. I for investment income, again we saw on the previous slide that investment income totaled out to $15,200. That needs to be eliminated. D for dividends, not applicable. And now we have this new entry, this intercompany transaction entry, the sale of lands. We just call that IT, I suppose. Again, you can use whatever letter you wish for the acronym. We need to go ahead and eliminate the $1,000 gain on sale of land that's on Little's income statement. So we debit gain on sale of land, and at the same time we have to reduce the land to its true historical cost. The land is being carried on Little's books, on Big's books, at $11,000. That's the price Big paid when they bought it from Little. The true cost is only $10,000. That's the price Little paid when they bought it from some external agent at some year in the past. So what we need to do is reduce the land from the reported value of $11,000 down to the true value of $10,000. Finally, we have our income to the non-controlling shareholders. Now in this case, in normal circumstances, the non-controlling shareholders would get their 20% of the subsidiary's reported earnings of $20,000. But again, we have to realize that of the reported earnings of $20,000, $1,000 of that was that unrealized gain on this intercompany upstream sale of land. So what we do is we say, okay, the non-controlling shareholders are going to get 20%. We start with these subsidiaries' reported earnings of $20,000, and then we look at those elimination entries and say, how did those elimination entries affect the income from the subsidiary? And the only one of those entries that has a income statement account on it from the subsidiary is that $1,000 debit to gain on sale of land. So it's easier in many respects to think in terms of debits and credits. We have a $1,000 debit to a gain on sale of land. Debits reduce our income, so we're going to give them 20% of $20,000 minus $1,000, or $3,800. Now let's go ahead and note our account balances at the end of the year. Little company has common stock of $50,000. Their retained earnings is now up to $70,000 because again they had $20,000 of income, for total owner's equity of $120,000. Our investment in Little has a balance of $95,200, and our non-controlling interest has a balance of $23,800. And again, if you look at the entries off to the left, the S entry, we have a $20,000 credit to the non-controlling interest, and then down under the Inc. entry, we have a $3,800 credit to non-controlling interest, total of $23,800. Now let's look at the relationship between Little's equity and those two claims on their equity. Now, before we had this intercompany sale, Little had owner's equity of $100,000, and the investment and non-controlling interest accounts combined added up to that $100,000. Again, equity of $100,000, we had an investment account of $80,000, and a non-controlling interest of $20,000. That relationship no longer holds. Now, Little's equity is $120,000. 80% of that is $96,000, but the investment in Little is only $95,200. Similarly, the other 20% of that $120,000 would be $24,000, but the non-controlling interest is only $23,800. What's the cause of that discrepancy? And as you're probably realizing, the problem is that Little's retained earnings includes that $1,000 unrealized gain on sale. Just summarizing what I just said, the problem is that Little's retained earnings includes that $100,000 unrealized gain that was included in their income. If we were to remove that unrealized gain, Little's equity would be $119,000, 80% of which is the investment in Little balance of $95,200, the other 20% of which is the non-controlling interest of $23,800. Now, how should we, or how can we adjust for this in our elimination entries? We know what our goal is. Our goal is to eliminate the subsidiaries beginning of year equity accounts, to eliminate the investment income, to eliminate the investment, to eliminate the unrealized gain, we have a bunch of different routes we can take to get to our destination. The way I'm presenting this is simply my personal preference, the way I think works in the most intuitively appealing manner. So let's go ahead and assume that the following year, just to make life simple, let's assume Little has no earnings at all, and again, they're not going to pay any dividends. Let's go ahead and go through our elimination entries. Again, we eliminate the subsidiaries beginning of year common stock and retained earnings accounts, total of $120,000 on the debit side, and we're just going to split that 80-20 between the investment in Little and the non-controlling interest. Now again, look at that entry and compare it to the information on the left-hand side of the screen. In all of the previous examples, when we did that S entry, we were eliminating the subsidiaries, we were eliminating the parents' beginning of year investment in Little balance, and we were reestablishing the non-controlling interest that we left off with at the end of the previous year. Now, however, we're crediting the investment in Little and the non-controlling interest for more than their balances were at the end of last year. We continue with our elimination entries, the A, the I, the D, not applicable. Now we need to carry forward that unrealized gain on the intercompany transaction. And again, we know we have to reduce the land. The land is on Big's books at $11,000, the true cost is $10,000, so we have to write it down by $1,000 again. And we're going to have to do that every year for as long as this land is owned, because although we're reducing it on the consolidated balance sheet, we're not actually reducing it on Big's ledger. So it's continuing to be carried on Big's ledger at 11,000, but for reporting purposes, we need to knock it down to 10,000. On the debit side, we're going to go ahead and debit the investment in little and the non-controlling interest. Basically, up in the S entry, we overdid it in terms of crediting the investment in little and the non-controlling interest. So in this IT entry, we're backing off and taking away the excess that we had credited up in the S entry. Again, in this case, please note that we're not eliminating the gain on sale. There was no gain on sale this year. The gain on sale was last year. Last year we eliminated it. Now we're carrying forward that unrealized gain and saying, how did that unrealized gain affect the other accounts in our accounting system this year? And again, we had to reduce the land, and we had to sort of clean up the relationship between our investment, the non-controlling interest, and the subsidiary's equity accounts. Finally, the income to the non-controlling shareholders, not applicable. The subsidiary had no reported earnings, and there were no elimination entries which affected the income from the subsidiary. Finally, let's assume that in the next year, Big sold the land to some third party for $15,000. This represents a gain of $4,000 for Big, because again, they bought it from Little for $11, now they're selling it to some third party for $15, they're showing a $4,000 gain. But from a consolidated perspective, there's a $5,000 gain. Little bought the land from a third party for $10,000, now it's being sold to another third party for $15,000, so again, there's that $5,000 gain. And let's further assume that Little again has no income or dividends this year, just to stick to the issue at hand. First, we do our equity method entries, and although Little doesn't have any income, and therefore we have no investment income from Little, we now get to recognize our share of that $1,000 gain that we deferred back in 2001. If you recall, back in 2001, there was a $1,000 gain on sale, but we said, no, that's not realized, we can't recognize it, so we took it away. Now it's finally been realized because the earnings process has been completed, the land has been sold to some external third party, so now we're finally allowed to recognize our share of that $1,000 gain. For our elimination entries, again, we start the same way we always do. We eliminate our beginning of year owner's subsidiary equity accounts, common stock and retained earnings of $120,000 combined, and we're going to split that 80-20 between the investment in Little and the non-controlling interest. I for investment income. Again, looking at that equity method entry, we recorded $800 of investment income. In the elimination process, that has to be eliminated. Now we have the intercompany transaction entry, where again we're carrying forward that unrealized gain for the last time. And again, this is based on beginning of year balances. We're going to go ahead and reduce the investment a little by 800 again, and the non-controlling interest by 200. And now, instead of reducing the land by $1,000 as we did last year, now we're going to finally put that $1,000 gain of sale on land on our consolidated income statement. That way, on our consolidated income statement, Big is going to report a $4,000 gain on sale because they sold it for $15,000 and their cost was $11,000. Plus, we're also going to add the $1,000 gain from when Little sold it to Big, at a $1,000 profit. Finally, we have our income to the non-controlling shareholders. And again, even though Little didn't report any earnings this year, we're finally recognizing that $1,000 gain that was deferred, that was taken away 2 years ago. The gain is now being recognized, and the non-controlling shareholders are going to get their share of that $1,000 gain. Now, the example we just ran through was based on the full equity method. What happens if the partial equity method is used instead? And again, we've always got two sets of entries that we need to keep separate first off, and we need to keep track of. Under the equity method, where the parent is accounting for their investment in the subsidiary, under the partial equity method, we wouldn't defer or eliminate the parent's share of the unrealized gain. We essentially wouldn't worry about the fact that part of it was unrealized. And since we didn't defer it when it was unrealized, that means that we don't have to subsequently recognize it when it finally does get realized. As far as our elimination entries are concerned, if this was the partial equity method, the only difference would be that instead of debiting the investment in little account for the parent's share of the unrealized gain being carried forward, we would debit retained earnings. The idea is that under the partial equity method, the parent didn't eliminate the unrealized gain, which means that their retained earnings, their income was wrong that year. They included an unrealized gain that shouldn't have been there, which means their retained earnings account is wrong. It includes that unrealized gain that shouldn't be there. So we need to correct that erroneous retained earnings balance in the elimination entries. Now finally, I can't stress enough that this adjustment to retained earnings in the elimination entries is going to be an adjustment to the beginning retained earnings in the worksheet. Whenever we have adjustments to retained earnings, it's always adjustments to beginning retained earnings. Now, what if this was a downstream sale instead of an upstream sale? When it was an upstream sale, we said, well, part of that gain or loss is on the subsidiary's income statement, and the non-controlling shareholders have an interest in or have a claim on that income. And so the unrealized gain or loss affects their income. Now, if this is a downstream sale, then that means that the non-controlling shareholders aren't affected by it. The unrealized gain or loss is on the parent's income statement, and the non-controlling shareholders have no claim on the parent's income. The equity method difference, now, under the equity method, we record our share of the subsidiary's income, dividends, and so on. When it was an upstream sale, the example we just ran through, we owned 80% of the subsidiary, and so we deferred 80% of that unrealized gain. Now, in a case of a downstream sale, that unrealized gain or loss is entirely on the parent's income statement, which means the parent, claims or owns all of that unrealized gain, and so they have to eliminate all of that unrealized gain or loss. As far as the elimination entries are concerned, since the non-controlling interest isn't affected by the downstream sale, they wouldn't be affected by the elimination entries arising from the downstream sale. It wouldn't affect the computation of the income of the non-controlling shareholders, since it doesn't affect them. And when the unrealized gain or loss was carried forward, it would all be applied to the investment in little under the full equity method, or retained earnings under the partial equity method. The non-controlling interest would not be affected by or involved with the elimination entries arising from this transaction. So real quickly, let's go ahead and do this as a downstream sale, same date, all the same data, but under the partial equity method. Okay, year of sale under the equity method. Again, if you recall the original data set, little reported earnings of $20,000. Our share of that would be $16,000. And under the partial equity method, we're done now. Again, partial equity method, we're not going to adjust our investment income to reflect or eliminate unrealized gains and losses. For our elimination entries, we start the same way we started before. We have our beginning of period subsidiary equity accounts of $100,000, which we split 80-20 between the investment in little and the non-controlling interest. I for investment income, we have a $16,000 of investment income that has to be eliminated. D for dividends, not applicable. This intercompany transaction, this is the exact same way it was before. There's a $1,000 gain on sale of land, and whether it's on the parent's income statement or the subsidiary's income statement, it has to be eliminated. So we eliminate the gain on sale of land, and we lower the land from its inflated value of $11,000 down to its true cost of $10,000. And then we have our income to the non-controlling shareholders. And again, they get 20% of the subsidiary's reported earnings. That intercompany transaction was a downstream transaction, and so it doesn't affect the non-controlling shareholders. In fact, when you're doing these examples, when you're going through these problems in the homework assignments, when you have intercompany transactions, it's often helpful to put either a big D or a big U next to the elimination entry, so you remember, was this a downstream transaction which doesn't affect the non-controlling shareholders, or was it an upstream transaction which does affect the non-controlling shareholders? The subsequent year, again, first let's remember little has no income for the following year, just to keep life simple. Under the equity method entries, we do nothing. They didn't have any income, so we didn't have any investment income. Our elimination entries, again, we eliminate the subsidiary's beginning of year owner's equity accounts, and we split those 80-20 between the investment in little and the non-controlling interest. A for amortization, I for investment income, D for dividends, all not applicable. And then we have this intercompany transaction entry. And again, on the credit side, we're reducing land by $1,000. On the debit side, two things to note. First, the non-controlling interest is not involved. This was a downstream transaction. It doesn't have any bearing on the non-controlling shareholders. The entire $1,000 is going to be applied as an adjustment to one of the parents' accounts. And since this was the partial equity method, again, what that means is the parent has that $1,000 unrealized gain in their retained earnings. They didn't take it out last year when they should have, or should have is the judgment term. They didn't take out that $1,000 unrealized gain, so their income was overstated last year, which means their retained earnings is overstated this year. And so what we need to do is we need to fix their retained earnings to get it down to its proper level. And then finally, the INC for income to non-controlling shareholders, not applicable because, again, there was no subsidiary earnings this year, and there were none of these elimination entries affected income from the subsidiary.